essentials.
Essentials as well. Steve, stay right there. Let's bring in our next guest, who has also been tracking a slowdown with consumers. Dean Maki is chief economist at Point 72. Dean, listen, your work was contrarian in the bullish way when the economy actually held up better than expected last year. So I don't like to see you taking a bit of a more cautious tilt on the consumer piece here. What do you see going on?
Yeah, I think real consumer spending is clearly slowing. We've seen that over the past 2 quarters, and I do think it's related to what you're talking about. Real wage and salary income growth has slowed down markedly. It turned negative in the first quarter, and we think it's going to be negative for the first half of the year as a whole, primarily because of that surge in inflation that we're seeing.
You know, Dean, this would be such a different economy if not for AI. If it hadn't come on the scene, going back to 2022, but even in the last 6 months or so, it sounds like, would you say from the top level data that it really is doing the heavy work of carrying the expansion forward?
Well, if we look at the different sectors, the only thing that's not slowing in the economy right now is the categories that are related to AI. So equipment spending, intellectual property, product spending. One thing I'd note, though, is that a lot of the equipment spending is on imported goods. So it's not necessarily translating directly into real GDP growth in a significant way. Some of it is, but that's one reason why we have seen real GDP growth slow to only 1.2% annualized over the last 2 quarters, in spite of the fact that AI spending is quite strong.
I'm just wondering, Kelly, how all this shakes out, because my comment of fortune favors the wealthy is not as glib as it may sound, in that the spending from the wealth and the wealth effects and the wealthy who are getting these wage gains could be enough to paper over these other issues we're talking about. You care on a human level about what's happening to low-income Americans, but whether and how much you care on a macro level beyond those individual stocks, for example, I just mean on an economic, not a human basis.
But that's actually why Dean's observations jumped out to me. It'd be one thing if we said, Steve, your survey is picking this up, but the consumption data is fine. But it's another thing when he's saying the consumption data is slowing.
What I think Dean's talking about, Dean, you'll be wrong. You had this decline from 1.9 to 1.6 on consumer spending in the GDP accounts. That's not terrible. It's not 2%, but it's not falling off the cliff, right?
Yeah, I mean, I'd characterize it more as we had been running at a 2.5%, 3.5% consumer spending growth rate. Now we're running in the 1.5% to 2% range, and I think that's going to slow further in the second quarter. So it is having an effect. We're not contracting; it's not recessionary, but it is a big slowdown from where we've been.
If you look at, Dean complicated it by being accurate, which I want to uncomplicate by being a little inaccurate, and I'll explain how. If you look at just the contribution of information processing equipment and add in intellectual property, they combined were 1.5% of the 2% GDP.
Wow.
Where Dean is being accurate is you also want to subtract the portion of that comes from imports, because that does subtract from it. But
the point still remains.
The point is really important, Kelly, that you bring up, which is whether or not what's happening with AI is papering over not just not growth, but maybe a deterioration in other parts of the economy.
And Dean,
that's the part to worry about if it's true.
And it goes, I think, Steve, you and I were talking about this a while ago as well, how there should almost be one interest rate for AI investment and one for the rest of the economy. But that gets, Jim Paulson has called this the boom bust, or he has some term like that for the economy. So, Dean, how do you categorize on a broader level what's happening here, especially how the Fed should think about it?
Well, I think certainly the AI is helping economic growth and helping us avert an even sharper slowdown. On the other hand, it is hurting on the inflation side, I should say. So, information processing equipment prices in the PC price index rose 8.6% year on year in the most recent data. So this boom is translating into higher inflation as well. So the Fed can't take one without the other. We're running at 3.2% core PC inflation. We didn't see that once in the 30 years prior to COVID.